You deposit your paycheck. The number updates. The screen relaxes. Everything feels settled, but the truth is, your money just left you. Not emotionally, not philosophically, legally. The moment your deposit clears, ownership changes hands, and almost no one realizes it. This matters now because most people no longer touch their money. It lives as digits, silent, weightless, trusted. We swipe, tap, and assume control. But modern banking isn't about storage anymore. It's about movement. And once you understand that, the system looks very different. Let's start with a simple moment. You walk into a bank with cash, real bills. You hand them over. What you imagine is a vault, a safe, a labeled drawer with your name on it. That is not what happens. Instead, the bank records a promise, a liability, a statement that says, "We owe this person money." That's the shift. You didn't store your money, you lent it. From that point on, the cash belongs to the bank, and you own a claim, a legal IOU. That's not a loophole. It's written into banking law. It's in the deposit agreement no one reads, and it's the foundation of the entire financial system. Now comes the uncomfortable part. What does the bank do with its money? It doesn't sit still. Banks lend it. They leverage it. They turn it into mortgages, business loans, credit cards, and investments. Let's say you deposit $1,000. The bank does not keep $1,000 waiting for you. It keeps a fraction, maybe 10%, sometimes less. The rest is loaned out. That loan becomes someone else's deposit, which becomes another loan, which becomes another deposit. The same money now exists in multiple places at once. On balance sheets, it looks efficient. In reality, it's a balancing act. Because if everyone asked for their money back at the same time, the system couldn't deliver. That's not speculation, it's math. Banks function because they hold all deposits. They function because people don't demand them. This is where confidence becomes currency. As long as trust holds, the system hums. When trust cracks, things unravel quickly. Withdrawals spike, liquidity vanishes, emergency measures appear overnight. And here's the irony. When banks get into trouble, support arrives fast. Central banks step in. Governments stabilize the system, not to protect individual depositors first, but to prevent collapse. Your money is important. The system using your money is critical. Banks sell deposits as safety. The economy treats them as fuel. You think your money is parked. It's actually circulating. And legally, circulation wins. Yes, there's deposit insurance, but insurance has limits, amount limits, time limits, practical limits. Insurance doesn't mean instant access. It means a process, especially during stress. Most of the time, this distinction doesn't matter, until it does. Now zoom out. When inflation rises, the number in your account stays the same, but its power quietly erodes. When interest rates change, banks adjust how they use your deposits. When markets shake, access depends on timing, not entitlement. Your balance looks stable. Its meaning is not. So who owns your money? Not you in the way you think, not the bank in the way they advertise. It's a shared structure, held together by law, leverage, and belief. A system that works remarkably well, right up until confidence breaks. And that leaves one question worth sitting with. If ownership depends on trust, if access depends on timing, if your money only exists while the system stays calm, then what are you really holding when you check your balance? And who's holding it with you?